All right, good afternoon, depending on where you are in the world. This is Ryan Payne. This is my mentoring session, and apologies, but apparently you were not able to ask questions because I didn't click on the right tab for today. I was wondering why I didn't get any questions, but apparently you were not able to do that. So now I know how to do it correctly. Sometimes I'm a little bit of a Luddite when it comes to technology, but any other questions you have, I'll make sure that I have my mentor session up there right after this session, so you can start adding them for next month. I try to do one of these monthly. And just a quick reintroduction, Ryan Payne. I have a wealth management business that I started from the ground up. So anything about business building, all the way to anything about financial planning related, I'm happy to answer your questions. That's pretty much what I do 24/7. And I did get a couple questions in here, so it might be a little bit shorter segment today, but I will try and make it engaging and exciting for you right before the Thanksgiving holiday. And what's better than talking about money? I mean, anytime we talk about money is always a good time, especially if we're talking about making money. So let's get right to the questions today. The first one comes in from Alex Scaler. I hope I pronounced your name correctly, Alex, but he writes in, Ryan, I'm relatively new to investing and looking for some advice on how to get started, 21 years old. Nice. I'm glad you're thinking about investing now. That's impressive. I would start with around 1,000 plus and consistently deposit over time, likely every week or month. Am I wasting my time trying to set something up with such little money? I realize 1,000 is not going to make me much. I realize 1,000 is not going to make me much money at all. I'm just looking for a container to put my money in that I can watch grow over time. Okay, Alex, I love this. It's all about starting young, and the fact that you're starting with anything, I think, is just absolutely amazing. So there's nothing futile about putting $1,000 away every week, every month. I would say that is like absolutely huge because of the compounding effect, because of your age. Every dollar you put in now just really is momentum at your back for later. It's like that snowball. It's like if you start further up the hill or when you're younger, that snowball effect is going to have you a much bigger snowball as it comes down the hill versus somebody who starts later on. So first off, no, I don't think it's in vain at all. I think it's smart to start with whatever you can start with, and maybe start 1,000 a month, but if you can do 1,000 a week or whatever it is, man, that's going to add up big time. So I think first off, establishing what you're going to save, no matter what that dollar amount is, start somewhere and you can always readjust later. Then the question I always ask, and when I'm looking at clients' accounts, is how can I optimize for taxes? You talked about putting your money in a container. So I always look at what are the tax benefits. And one line that I like to say ad nauseum is money saved in taxes is just as green as any money you can make invested. Or another way of saying that is it's not what you make, it's what you take. So given your situation, given you're young, given the fact you're getting started, I really love the Roth IRA. Now, if you're in the States, I didn't see where you're located. With a Roth IRA, basically, you get no deduction, or there's no benefit to put the money in. Okay, so like with a traditional retirement account, you typically get a deduction for any money you put in any given year. With a Roth, you get no deduction to put the money in, but you can put up to $5,000 to $6,000 into a Roth IRA, depending how old you are. I think it's $6,000 this year. I should double check that. But the beauty of it is the money in that account is going to grow completely tax-free, and then when you take it out, all that growth is completely tax-free to you. Now, you can't touch that money until you're 59 and a half, but think about all of that snowball effect of that money growing over time and not ever paying taxes on it again. It is just a huge, huge advantage. It's something I still do. I make over it's also income constraints to do that, so I'll put that caveat out there. I'll put some information about the Roth after the segment. But there's also ways, even if you make too much money, you can still do a Roth IRA. It's called a backdoor Roth. Not to get too nuanced, but anyone who's making some real money now, maybe over like, I don't know, 200,000 a year plus, there's still ways to do a Roth IRA, but there's a little bit of engineering that has to be done. So the point is, I think that's a great place to start, especially if you don't need liquidity or access to the money and you're thinking long-term. But I would definitely look at the Roth IRA. And if you run your own business, there's always opportunities to set up a retirement account as well. But I think that's just a very simple, quick way to get started. And I think the lesson here is tax benefits, and it's never too little to start putting away and saving. And the compounding effect that is tremendous. And at 21, man, we're all jealous of you. that you're even thinking about this early. I wish at 21 I had started thinking about just putting away as little as a couple $100 a month, never mind $1,000. So great job on that. If you have any questions, you can ping me offline, and we can break it down for you a little bit further. But I just love the way you're thinking, and I think it's great to get started with savings, as soon as you possibly can. Okay, so next question comes in from Patricia Lynn Burgess. Hello, Patricia. I know I've heard from you in the past. Hi, Ryan Payne. Thank you for your time. You're welcome. Question is, if I'm an investor beyond like my 401k IRA in the past with say $10,000 to invest somewhat aggressively, what would be your guidance here? Okay, again here, you mentioned your 401k or an IRA, which I do like, again, because I like tax benefits, and you should like tax benefits too. So, I'd always look to max out your retirement account at work. A lot of you I know are working, you're self-employed, you've got 1099 income. So there's a lot of opportunities to put together an individual retirement account for you. And the nice thing about that is you can get even more money away before tax, and there are big deductions you can take off the top of your income. Now, above and beyond that, once you have maxed out your retirement account, then you want to start looking at ancillary places that you can put money, or containers. I like the way that Alex actually put that in his question. So the Roth IRA, again, is something you could potentially look at depending on your income bracket. And even if you make over a bracket, there's loopholes to do the Roth IRA as well. So if you haven't looked at the Roth IRA, I really, really like that. Now, once you've done that, there's also a health savings account depending on, if you work for a company, they have that option, or if you have what you call a high deductible plan, you could do a health savings account where the money goes in pre-tax. It grows tax-free, and if you use it for medical later, you can take it out tax-free. So that's triple free taxes, and you can invest money in a health savings account, which a lot of people don't know that. They just use them for their expenses year over year. I think that's not a great way to use those funds. I'd rather invest them longer term, so it's a much bigger pile of money later that you can draw on completely tax-free. And not to get, again, too nuanced, but that's something you look at as well. And then, once you max out those benefits, or say you don't want to lock your money up long-term, you can always open up a brokerage account, and there you can get a little more aggressive with the money, get into a full portfolio that's in the stock market. Now, when I talk about investing your money aggressively, or the way I want you to think about it is, it's all about time horizon, okay? So if you're telling me I want to invest my money aggressively, but I'm going to need it in 2 years, that's a very bad combination. Because if you invest your money aggressively, you don't really know how your money is going to do in the short term, especially when it comes to market investments. Stock market's very volatile. It goes like this in the short term. However, in the long term, if you look at the long-term trend, markets have gone a lot higher over time, and those odds of that happening again are very good. But you need the time horizon for it. So if I have aggressive money in my portfolio for my clients, I know the time horizon on that money is a lot longer. I can afford to see it fluctuate, because the rule of thumb, again, on top of that would be, the more I can grow my money out, the more aggressive it is, the bigger swings I'm going to see in that money. So I'm happy to get, 12% annualized returns, which is an amazing return on your money, but I have to be able to suck up in some years, maybe going down 50%. There's no free lunch when it comes to investing. So there are all the things I want you to think about if you're going to say, I want this money to be more aggressive, is really like time horizon, and can I stomach the volatility on that money above and beyond, where am I going to save it and what type of account. So I hope that's helpful. That gives you a couple different accounts you can utilize above and beyond your IRA, your 401k, and also just some things to think about risk. Because the other irony of investing is, and I actually talked about this today on our podcast, and I think it's something that a lot of us miss, is ironically when it comes to investing, typically the more conservative strategy does better than a more aggressive strategy over time. And that sounds counterintuitive, because you're like, if I'm taking more risk, I should get better return. But the problem is, it's not really about capturing all the upside when the market's doing really well like it is now, but eventually the market's going to go down. And the account that has, or the portfolio that has more protection in there, is going to lose less in the down market. And losing less in a down market is more valuable than getting all the money when the market goes up. And what happens over time, by losing less and getting more consistent returns, you end up with a better long-term return than saying, I'm just going to go aggressive with my money. Another reason for that too, and I don't want to get too nuanced here, is there is going to be a day when the market goes down. And for all of you creating wealth, which most of you are in that stage right now, that is a gift from the gods, because whenever you're buying anything, whether it's things are on sale because of Black Friday coming up and prices go down, it's the best time to buy something in any marketplace, no different in the stock market. If the market goes down and you're saving, you're putting money into your 401k or your IRAs or wherever you're putting it, that is the best time to buy because prices are lower. Now, if your money is already all in the market and it takes a huge hit, the problem is you don't have any money on the sidelines per se that you can take and buy when the market's down. Whereas if you have a more conservative strategy, you can have some money over here in things like bonds that are safer that you can use to buy when the market actually goes down, which again, having that more conservative strategy gives you benefits that having the more aggressive strategy doesn't. Okay, I went down a little bit of a rabbit hole there, but I think you get the gist of that. So I always get a little nervous when someone asks me, Ryan, like I want an aggressive strategy, because remember, you can get to where you need to get to with a more effective, more conservative strategy if you're smart about it. So hopefully that's helpful. Again, you can always ping me offline if you have some more questions about that, but I think that's an important thing to think about. Okay, so let's keep moving. We got a question from Jason Antonino, which, Jason, you've sent me some questions in the past. Thank you for sending me these questions. I think actually this came up on the board a couple days ago, but it was a good question, so I'm going to repeat it and I'll answer it for you here on the mentoring session today. Ryan, the question that I asked is, hey, I've been managing a UTMA custodial account for my son for the past 12 years. A UTMA account is a Unified Gift to Minors Act account, meaning that you're the guardian on an account for one of your children is basically what you see. That's the normal course of how a UTMA account works, just to explain that. He turns 18 next June, and I'll be required by law to disperse those funds to him. Most of the money is invested in 2 ETFs or exchange traded funds and a small amount of cash. My question is, when is the right time to liquidate those ETFs into cash? 6 months before his 18th birthday, 3 months before, or some other time? Thanks. Okay, so a couple things here. Let's unpack this with a UTMA account. First off, you don't have to liquidate anything. You can simply take your name off the account, and now all of a sudden the money is in your son's name in this case, and he can keep it invested in the same ETFs that you're invested in now or whatever investments you're in now. Okay. Now, one thing I know a lot of my clients do is maybe your 18-year-old, and your 18-year-old might be the most responsible young man in the world, but I know what I was like at 18, and it wasn't really a good idea to give me any money to spend on frivolous things, especially with college coming up and things like that. What a lot of my clients do, and you can kind of get away with, is you don't necessarily have to let your son or daughter know that money's available. They have no way of knowing that that money is there, and maybe later on when you think they're more responsible, you can tell them about the money and then remove your name at that time. So one strategy is you don't really have to go out of your way to let your son or daughter know they have that money, and that can work really, really well. On the flip side, maybe they are responsible. Again, you can take your name off the account, you can give it to them. This, again, could be another opportunity to use what I call that Roth IRA. This is like the theme of today, where maybe they had a job in the summer and they made a couple $1,000s. Well, maybe what they could do is put the money now in their name or take your name off their account. Then they could contribute some of that money to a Roth IRA where the money, again, is going to be tax-free for the rest of their life. And I used to do that too. I had money from summer when I had jobs in the summer, and I would take those earnings and I would actually put them into a Roth IRA. Again, just because the tax benefit on that is just so fantastic long-term. So that's something else creatively that they could do, especially if they're responsible. On the other hand, you can maybe not tell them about the money for a little while longer and wait for them to be responsible, but hopefully that's helpful in regards to, some things you can do there with a UTMA account. I actually got a couple more questions. Sean threw me a question here. Thanks, Sean, just to liven up my accelerator session here. He writes in, Ryan, what's your prediction for 2020 for the U.S. economy? Oh boy, I love to talk about this stuff, and I do it weekly. And my thoughts are, and I love to be counter to what you're hearing out there, and having the contrarian view, in my opinion, is always the right view. And if you've been watching a lot of these shows, A lot of these prognosticators out there have been really spouting doom and gloom for a long time. You hear the economy is slowing. The global markets, or the global economy is slowing right now. Manufacturing is slowing. Things are growing at slower paces than they used to, right? It sounds like we're ready to fall off some kind of cliff. And it's exacerbated by the fact that this is the longest economic expansion in U.S. history. There's never been a time where the economy has grown for a longer period of time. So the rational thinking is, well, we've been going up now, the economy and the market now for over 10 years, like we must have this decline now. That's not necessarily true. So the other side of that coin is it's been the slowest economic expansion of all time. So even though we've been growing for a long time, it's been at a very slow pace. And now why this is important is what usually causes a recession in the economy is when things get overheated. And by human nature, our nature is to overdo things, right? Remember when the housing bubble bursts, a lot of us are guilty of maybe over leveraging ourselves. If you're in the real estate business, you know how crazy things got. I remember doing no doc loans for people back then. Think about that. Like the only way you had to verify your income is you wrote it on a piece of paper and we believed you and we gave you a loan. Like crazy stuff. And before that, the tech bubble burst. And that's when these valuations on these tech companies that made no money just got to crazy levels. We don't have that today. So because the growth has been so slow and steady, it's very unlikely that we will go into a recession just because there's no real overheating in the economy. Furthermore, you've never gone into a recession when you have unemployment going down. Unemployment right now, and a lot of you know this in your own businesses, it's really hard to hire right now, is because we're at like, somewhere around, I don't know the exact number today, but it's like 3.6, 3.7%. I don't remember the last month reading, but that's the last time unemployment was that low was 1969. That's 50 years ago. So you've never gone to recession with unemployment going down, and also in addition to that, wages are going up. And what you have to remember is the U.S. is not a manufacturing economy. It's only about 10% of our total GDP or the total revenue we generate as a country. And I hope I'm not going on too much of a tangent here, but that's a very deceiving statistic that's used a lot on TV. I know because I do a lot of these shows, and I'm probably part of the problem too. But the point is manufacturing is not really drives our economy. It's you, the consumer, and me, the consumer, the American household. As long as we're doing well, that tends to push the economy further, and we're a service-based economy. The majority of what we do is we provide services, not good old-fashioned manufacturing. So it doesn't really drive the economy. So it's kind of a fake headline when you hear about that contraction in the economy. So long story short is because American households are in such good shape right now, people are not as leveraged as they used to be. We've become much more fiscally disciplined. In fact, the savings rate in this country right now, which is like over a decade high, is 8% a year. We're all putting away our money. And I think a lot of that has to do with the Great Recession. We all were kind of scarred from the Great Recession. So people just play it a lot safer right now, and businesses do too. Businesses are a lot less leveraged today than they were back in 2008 when we had the Great Recession, and their balance sheets are in much better shape, just like the American household's balance sheets in great shape. So these two reasons, I would argue, are probably going to drive this economy to be a lot stronger than what you're hearing out there by the quote-unquote experts, who don't get it right very often, by the way. They're usually wrong. So that's another thing to think about. We actually call the financial news financial propaganda because a lot of it's entertainment, and there's not a lot of really good value in these warnings and things you hear about the economy. So I hope that's helpful. I'm going to see if there's any other. Oh, I got another question. All right, so we'll keep it going. This is becoming a more engaging session than I even could have dreamed. So any idea how e-commerce would be affected then? I'm going to assume, is this in playing into the U.S. economy doing well or not, Jacob? I'm assuming it plays into that. I'm going to say e-commerce is probably going to do well. I think, we have the holiday season coming in. I would expect the holiday numbers are going to come in very strong because, again, the consumer is in really, really good shape. And I call this, it's a little bit of a cognitive dissonance between what you hear in the media and what we're actually experiencing right now in the real economy. And I have a lot of business owners that are clients, and they'll say to me, Ryan, we got to change our portfolio strategy. Recession's coming. It's so bad out there. And I'm like, where'd you hear that? Well, I was watching the news. Of course you're watching the news. Then I ask this question, and you can ask this question to yourself right now. You can ask yourself, how is my business doing? And invariably what I'm hearing more than not is my business is rocking right now. My pipeline looks great. I've got a lot of opportunity. And I'm like, now extrapolate that out to all the other business owners in America. They're feeling the same way right now. So what you're hearing in the media versus what's really happening in the real economy is, again, it's this big cognitive dissonance. What's going on in the real economy is really good. And I like business owners in terms of projecting out, because business owners drive about 50% of employment is in the private sector by small business owners like you and me. And whenever you know your pipeline, you know what it really looks like over the next 12 months. And I look at that business confidence is a really good indicator to look at on a monthly basis. And that's been very, very high now for a long time. So when that's good, that's also a good litmus test, a forward-looking indicator that the economy is good. And tie that back to your question, Jacob. I think that'll probably be good for e-commerce, because I just think that Americans right now are in great shape. They can afford to spend, even with these tariffs in place, which have had a very little effect. Again, unlike what the media is telling you right now. And the other thing is the dollar is very strong, which that acts almost like a stimulus for you and me, because we can buy goods and services around the world right now at a very cheap rate just because our currency is so strong versus the rest of the world. That also plays into oil prices being reasonable and things like that. So, despite what the media is telling you right now, and our philosophy here when I'm investing for my clients and making sure they're good for retirement, is we're very, very optimistic on the future. And if you look at it statistically, this is the time you want to be optimistic. And it's very good when, it sounds counterintuitive to say this, but when the experts are very negative, that's actually a very positive sign. I get nervous when everyone's feeling good. The media is telling you that, this economy is going to go on forever. That's probably when we're getting closer to a top. But when you have that negativity out there, it just keeps things in check. So it's good for you, for your business, and it's very good to be an investor right now. And even globally, just to add one more thing there, and I'm going to shut up because I feel like I've been really, really going on here. But if you look at it globally right now, even the foreign markets, even though the press isn't great, their economies are kind of at a trough right now, where their economies are starting to pick up too. So if you're investing your money in your 401ks and your retirement plans, I really urge you to invest in a global portfolio. Don't just invest in what did best last. The U.S. has done very well for now a decade. Not a bad place to be, but you're missing out if you're not invested globally. If you look at 75% of the GDP is outside the U.S. We have a huge deficit in the U.S. We have a aging population. The rest of the world's growing faster. Valuations around the world are cheaper, meaning it's a better buy. The younger populations in the world are globally. So the opportunity is not necessarily going to be the U.S. in the next 5 to 10 years. It's going to be global, and you really need to position yourself that way as well. So just another caveat there. I got one more question. Man, they keep coming. All right, so I'll keep going. So Mark McDowell, this kind of just answers the question that I think I just answered, but what are you putting retirement accounts in these days? I'm 100% invested globally right now. Foreign markets are a lot cheaper than the US, and they haven't done as well, which as an investor, you always want to buy the things that are down, not up. You still want to have what's up in your portfolio, don't get me wrong. I don't think the opportunity in the US is done, but you've got to have a global portfolio. You really need to know the whole world right now. You're going to miss the best opportunity the next 5 to 10 years for so many different reasons. Anything else you need to own in your portfolio? I think one thing to stay away from are bond funds. So if you're trying to build safety in your portfolio and buy bonds, I wouldn't buy a bond fund here, because bond funds essentially, and I'm going to get a little wonky, but interest rates are very low. If interest rates start to go up, bond prices start to go down. And in a bond fund, you're going to have the bond price go down, and you own this fund with all these other investors. It's like yelling fire in a crowded theater. You're going to get people panicking at the same time, and that could very easily happen now with rates as low as they are, because the economy is, again, I mentioned, around the world are getting better. That's going to start to drive interest rates a little bit higher. So I'd avoid bond funds. I'd invest globally here as some of the broad strokes when you're building your portfolio, but they're definitely things that you want to be doing here that I'm doing for my clients. You need to be forward thinking when you're investing, not just looking in the rear view mirror, because the biggest mistake I see investors making right now, and we analyze like 100 portfolios a month, I literally see everything, is A, you probably have too much cash where you're earning nothing. Cash is trash. You're losing against the purchasing power over time. But the other thing is your portfolios are too US centric. And over time, the foreign markets do just as well as the US markets do. So you've got to diversify that risk. So there you go. So hopefully that's a couple insightful things you can take before the Thanksgiving holiday. Again, sorry about not having the ability to ask questions throughout the month. I now know what to do, so this time you'll be better off. I want to wish everybody a really happy Thanksgiving. I know everyone's probably been hustling. I know I'm exhausted, so hopefully everyone takes a little time off, chills with the family before that crazy push before the end of the year. So I'm wishing all of you and your families a great Thanksgiving. Really enjoyed doing these sessions. I'll put one up for next time. Again, any questions you have, financially related, business related, I love talking about it. And feel free to ping me offline. I'm happy to answer your questions. I enjoy doing it, and it's a great group to be a part of. So happy Thanksgiving, and we'll talk in a month. Thank you.